Welcome to the Mind Your Business Show. I'm your host, Tony Calloway, your private money godfather, and today's topic is going to be about life insurance. Why is it so complicated? So what I want you to do is go grab your pen and paper, and when we come back, we're going to explore this topic, and you're going to be excited by it. And I'll see you when we come back. All right, welcome back to the Mind Your Business Show. I'm Tony Calloway, your private money godfather, and like I said, today's topic is life insurance. Why on earth is it so complicated? Well, life insurance is something we've all heard about, all of our lives, and it's just an intricate topic. And so what I want to do today, out of my 30 plus years of experience in that field, is to help you to make sense of it, not only so that you can become an informed consumer, but you can do things the right way. All right, so let's go ahead and get started and talk about what you're going to learn today. The different types of insurance policies. There are several different names or brands and things like that, so that's part of the confusion, but there's 4 basic types. We'll discuss that. Why people need to have life insurance. We're going to discuss the factors that affect getting life insurance and how that affects the cost. The type of insurance companies and agents, and how an insurance agent can help you to get the right insurance for you and your family. All right, so let's start off with the definition. I always want to make sure we have the textbook terms. So life insurance is a contract between an insurance policy holder and an insurance company where the insurer promises to pay a sum of money upon the death of the insured person or after a set period of time in exchange for a premium payment. Now, the key thing here is there are several parties to this, but the most important thing I think I want to draw your attention to right at the outset is that it is a contract. Right? And contracts have certain qualities to them. For example, they have specific performance, they have who the parties are, they have consideration and all those kind of things. So understand that document that you may get from an insurance company through your agent is indeed a contract. And within that contract, it has a lot of stipulations that part of what I want to do today is make sure that you can understand those and how they apply to your situation and needs. Now, there's this thing called a life insurance buyer's guide, and as you see there on the slide, it says it's provided by NAIC. NAIC is the National Association of Insurance Commissioners. Now, each and every state has an insurance commissioner, and together they've come up with this document as a buyer's guide to help people to make informed decisions about their insurance needs and how to go about it, the different kind of policies that we're going to discuss now. But now, here's the thing. By law, the insurance buyer's guide, the life insurance buyer's guide, has to be provided no later than the delivery of the policy. Well, doggone. If you've already bought the thing, learning about the ins and outs is kind of like, closing the gate after the horse has already gotten out, right? So if you want to get a copy of the life insurance buyer's guide, you can contact us at the Private Money Syndicate, and I'll get you a digital copy. Or when you're in the market for life insurance, you can go online and probably just put into a search life insurance buyer's guide, NAIC, and you'll be able to find it there. But today, as we talk about life insurance and why it's so complicated, we're going to make sure that you understand a lot of things, because most of what I'm going to talk about today actually came from this buyer's guide. All right, why do people own life insurance policies? Why do you need life insurance? Now, oftentimes when people get it, somebody says, well, go get life insurance or some life event happens, but there are some very specific purposes. And I want you to put it in this context. When you buy car insurance, it's to protect or replace a car. Homeowners insurance to replace or protect your home against some type of loss. If you have renter's insurance, health insurance, those kind of things. Well, life insurance has these muddled notions about why you need it. So let me hit the main ones for you. To replace a breadwinner's income. One thing for sure is when somebody dies, their paycheck stops, okay, if they're a wage earner. So for those dependent upon that income, the life insurance policy is here to provide that replacement. It's also available to pay off the mortgage, to make sure that the family or the survivors don't have a house note to worry about, as well as any other consumer debts, such as a car, credit cards, and those types of things. Because as part of selling a person's estate, one of the first things that has to happen is all their creditors have to be made whole. To fund children's college education. College is really expensive and getting more expensive, and nobody would like to think that they died without making sure that their children were prepared for success in the world through the benefit of having a college education. Now, in addition to personal or family uses of life insurance, there are also business uses for insurance, such as key man insurance, replace a key employee, as well as what's called a buy-sell agreement. Now, I'm not going to get into the details of that, but if you're a business owner and you have partners, having a buy-sell agreement is something that you definitely want to explore and maybe have your agent help you with. So those are the key reasons why people need to have life insurance. All right, now let's talk about who the parties are. Remember I said that life insurance is a contract. So the insured is a person whose life is covered by the life insurance policy. So if that person died, the insurance company pays off. Now the insurance company is the issuer of the policy. They're the one who actually create the terms of the contract. The policy owner is not always the insured. So a person as an adult could have an insurance policy on their child. So the child would be the insured, but the policy owner would be the parent. So from the standpoint, the policy owner is important because they're the person who controls the policy. All right, so that policy owner could be the insured, but it could be a third person. And then fourth is the beneficiaries. All right, now beneficiaries who would receive the death benefit. So if someone died, identified in the policy is the beneficiary. Now, there are various types of beneficiary designations. Typically, it's just the beneficiary, but there could be an irrevocable beneficiary. That's a case where that person cannot be changed from being the beneficiary of the policy. And then there are contingent beneficiaries, where if the primary beneficiary died before the insured, then who would be next in line? Those designations, again, are important reasons why you might want to have an insurance agent to help you with your life insurance planning. Now, the primary goal of the Private Money Syndicate is to help you to power your dreams with private money. Now, the Private Money Syndicate is the sponsor for today's episode. And if you want to learn more about the things we do to help you to power your dreams with private money and life insurance, you can reach out to us by going to the website, privatemoneysyndicate.com, or you can call us at 706-888-3719. So moving on here, look at the need for life insurance. How much is enough? Now, most people just buy some, to be quite frank with it. It's not like buying gas where, you won't fill her up or only get a half a tank. No, there is a very specific number, just as it's going to take a very specific amount of money to repair your home or replace your home, repair your car or replace your car. There are very specific numbers that someone needs to contemplate when it comes to life insurance. But here's a fact, a sad fact, and that is that 44% of households would encounter significant financial difficulties within 6 months, within half a year, if they lost a primary breadwinner's income. And more than that is that 28% of families will reach this point in only 1 month. Now, considering the fact that life insurance is relatively inexpensive at early ages, the sad fact is because there's so much confusion, such a lack of knowledge and understanding and information that most people don't have enough life insurance. And again, this statement comes from ForbesAdvisors.com. So here's some clues that you might be underinsured. And the first is, I've heard so many people say, I got insurance on my job. Well, that might be an indicator that you're underinsured, because most employers will give you somewhere between 2 to 5 times your annual salary. So if you think about this, if you spend most of all your money, then 2 times that in a year or 2 years is all gone, or 3, 4, 5 years. So how much insurance is enough is great, and probably the most inexpensive way that you can have insurance is through your employer, but it's often woefully insufficient to meet your family's needs. You pick a coverage amount without calculating your needs. You just pick a number out of the sky. I want 100,000. That sounds like if somebody hands you $100,000, that make you happy, but if you got to replace your $50,000 a year income for the benefit of your family, 100,000 is not enough. Again, a specific number. You have a new addition to the family. Now, I just researched this before I came on air today, and it says it takes about $16,088 a year per statistics in 2022 to raise a child. That's pretty expensive. And again, if you have multiple children, you have to multiply that. So when you add another child to the family, then you just added $16,088 to your expense profile. And so you want to make sure that if a breadwinner dies, that income is provided for the benefit of the expanding and growing family. You bought a new home. Well, most new homes cost more than the old home, so you want to make sure if you want to pay off that mortgage that you have enough insurance to do that. or your income has increased or your lifestyle has changed. So now if you've upped the ante and need more money to maintain, then again, the family is going to need that whether you're here or not. And then the last point is, it's been several years since the last time you reviewed your life insurance policies. And again, this is something that you ideally should do specifically when there are changes in your circumstances. Family grows, buy a home, get a new job, lose a job, those kind of things. But just on an annual basis, because needs do change, products do change, and make sure that you have the most recent and current assessment of your life insurance needs. You need to look at that every single year. Now, when we talk about calculating how much insurance you actually need, there's an acronym called DIME, D-I-M-E. And DIME, the D stands for debts, I stands for income replacement, M for mortality expense, and E for education. So you want to pay off the debts. Remember I said by mandate, in selling someone's estate, the debts or the creditors have to be taken care of. We've talked several times about income replacement, making sure there's enough money coming in to continually provide for the family. Mortality expense, now what is that? Now, you can't die for free. What I mean by that is there's usually the hospital bills or medical bill co-payments, those kind of things most likely. But then the mortuary has to be paid as well. If you're getting a funeral plot, then that's got to be paid for. So there's some dollars associated with those things that you can anticipate and pay for. And then the last one here, the E, is for education for the children that may be left behind. So DIME is an acronym that if you do the numbers associated with those, it's going to help you to reach an assessment of how much you need. Now, I don't know if you're able to read this, but here's this DIME acronym put to some numbers. So now what we're looking at here is a family's debt situation, and they've got their mortgage and their consumer debts, all of which adds up to about $250,000. Now we look at income replacement, it says $50,000 a year for 15 years, so they just did the linear math on that. Mortality expense, $8,000 for the funeral, $10,000 for the health care expenses that might be lingering. And then education, $20,000, 770 times 4 years times 2 kids. All that adds up to a total of $1.1 million that is going to take to make sure that all those aspects of debt, income replacement, mortality expense, and education are attended to. Now, the 1.1 million, they have 100,000 on their job. Okay, cool, because remember 2 times $50,000 a year income, 100. So subtract that, and their need to buy personal policies, individual life insurance, is $1.094 million. All right, this is very formulaic, this is very scientific, and just like would be the case for someone getting car insurance or homeowners insurance, there's a certain dollar that is easily identified in that particular case. But here in life insurance, because there are these multiple facets that have to be reconciled, I just gave it to you. Very easy formula, D-I-M-E, DIME, that you can walk through and determine what your need is for life insurance, and don't let the sticker shock fool you, okay? There are very easy ways to make sure that your family is adequately protected. Now again, the Private Money Syndicate is not only here to power your dreams, but we're here to make sure we power your life with good, solid information about all these things. Investments for real estate, starting and growing a business, as well as having adequate income protection, as we're discussing here through life insurance. So reach out to us at privatemoneysyndicate.com or give me a call at 706-888-3719. All right, so now, we've talked about the needs. So what are the things that affect price? Because you say you're shopping around, go from one company to the next, and the cost is different. Why? All right, well, let me give you a breakdown. First thing that goes into consideration is gender. Because women typically live longer than men, their cost for insurance tends to be lower based on gender. So if you had 2 people the same age being next, and one's male and one's female, the female would have lower rates. Now, a number of companies, and I won't say most, but many companies now have what they call unisex rates, which is, regardless of gender, then you'll just be associated with the age. But again, if a husband and wife at the same age, they apply for the same amount of insurance, the wives will be less because, again, the gender differential as far as premiums are concerned. Age, the older you get, the more insurance costs. So I always tell people, get it when you're younger and healthier, maybe get more than your math says you need right now. But as you grow into it, that's the likely thing to happen as you buy a house, get married, have kids, those kind of things. Now, whether or not you use tobacco users pay more, so and non-tobacco users pay less. The main thing people think about when it comes to life insurance underwriting that determines the premiums and so forth is medical history. Now, the healthier you are, the less likely you are to have your rates increase because of health conditions. I remember many years ago when I thought I was in perfect health, I went to increase my life insurance from $1 to $2 million, and come to find out I got like crazy high blood pressure. So the more important thing is, again, stay on top of your health as you have your annual physicals and things like that, but understand that your medical history can have an impact on your life insurance. So again, when you're young, healthy, and all that stuff, get it. Occupation and recreation. Now, occupation, if you have a hazardous occupation like somebody who washes windows of skyscrapers or things like that, or maybe you're a trapeze artist, I don't know. I know that sounds crazy, but again, your occupation exposes you to certain risks and hazards, then that could cause your insurance to cost more. Recreation, if you have your private pilot's license. You hear me talk from time to time about aviation. I used to have my private pilot's license. Well, if you're a private pilot, then you're going to have that factored into your insurance cost. If you're a deep sea scuba diver or something like that, again, recreation can have an impact. And then the last thing is underwriting class. Now, some of these come as a result of the previous points I just made, but the main classes are preferred. That's somebody in great health, low risk occupation, young, height, weight is right in line. That's preferred rate. Standard is the hump in the bell curve, which most people fall into. And then rated is because somebody's got some of these, I'll call them impediments. For example, poor medical history or some medical issues, maybe uncontrolled high blood pressure, uncontrolled diabetes. Not that they could not get insurance, but because their risk is higher, their rates will be elevated somewhat. And then there's also, again, as I mentioned a few minutes ago about recreation, if they're doing something occupationally or recreationally that puts them at more risk, then that could have an impact on their rates as well. So these are the factors that go in determining someone's insurability and their premium rates. All right, now let's talk about the main types of insurance. There are 4 main types of life insurance: term, whole life, universal life, and variable life. Now, you probably heard all of these, and to you, one doesn't mean any more than the other one. So the most important thing I want to accomplish in this part of my discussion is helping you to understand what's unique about each one of those and how they may or may not fit into your circumstances for insurance coverage. All right, first is term. Now, term provides the lowest cost coverage for a specific period of time, a term. For example, 10, 15, 20, 25, 30, they have 35-year term policies. But the key thing is that they are for a specific time period. Now, most term policies do not build cash value. Now, they do have some of these different kinds, I won't say weird, but different kinds that do, which is baffling to me, but most don't. They're just strictly debt protection. You don't have any savings accumulated in your car insurance or your homeowner's insurance. Well, term life insurance is just like that, it's strictly protection. Most term life insurance coverage can be continued or renewed at the end of the term period, even if someone's health has changed. That is called guaranteed renewability. That is a factor because, again, as you get older, health changes. So if you do have term coverage, I would definitely say look at that guaranteed renewability. And those types of terms cost a little bit more because, again, the insurer is taking on the risk that your health may have changed as time goes on if you choose to renew the policy. Now, if you renew, or when you renew term insurance, the new premium is going to be higher. You know why? Because you've gotten older. So if you had a 20-year term from age 20 to 40, at age 40, when you get ready to renew, say for another 10, 20 years, then the cost per month for the same amount of coverage is going to be higher because you've gotten older. Now, you might say in those 20 to 40 years, I've taken care of a lot of things, maybe gotten close to paying the house off. Kids are 20 years older, maybe out the house now, and I don't have as much income to replace for a shorter period of time on the backside. That's why a lot of people are recommended to buy term insurance for those reasons. And now the next point is, ask if you lose the right to renew the policy at a certain age. Now, I talked about renewability, but now some policies are renewable up to a certain age, for example, age 65. So now, after age 65, if you can't renew, guess what? After age 65, it's probably you're older and sicker, right? So understand whether or not the policies that you're getting have that benefit provided for you or that guarantee provided, or if it's not there. Again, what you're doing through life insurance is transferring risk. And the greater the risk to the insurance company, the more it's going to cost you. That's why these cost differentiations come into play. And then the last is a non-renewable term can't be continued. If it says it's non-renewable at the end of that time, that's it, all right? But remember, term is like car insurance, homeowners insurance, it's strictly protection. Ain't nothing wrong with that, but understand that's why it's inexpensive, and that's why in most cases, now again, say most cases, it is the right way to take care of those temporary needs. For example, paying off homes and things like that, always absolutely a best shot to be able to do those. Next is whole life. Now, for most people, that's the one they probably heard the most about. That's called a permanent policy. Whole life, it covers you for your whole life, from the time you get it to age 100, which is where most insurance policies actuarially, if you ever heard that term actuary, say that's your life expectancy. Well, I hope you make it to 100 as well. But now the coverage can last for longer periods of time, your lifetime, and these types of policies build up cash value inside the policy. So part of what you pay every month, some of it goes to cover the pure cost of insurance, and the rest of it goes into accumulation that helps to offset risk later on. But now the other thing that provides for is that you can borrow against the policy, which means you get to keep coverage, take some of that money out as a loan, which reduces your face amount, your protection by whatever you take out. That makes sense. And you have the option to pay it back, but they're going to be charging you interest until then. Or you can cash the policy in or surrender it. That's called surrendering. And that means that you're able to just, hey, y'all take your insurance back, just give me my money. And that is what most people consider a benefit in light of the fact that if you terminate coverage, there is some residual. But remember, that's money that you actually paid into the policy. And then the premiums are paid according to a set schedule. So if it's $150 a month, it's $150 a month. However old you are, the same amount of coverage, that is not going to change. So that is whole life. Again, it covers you for a longer period of time, your whole life, and accumulates cash value. And now there's another type of cash value accumulating policy, which is called universal life. Now it has several names. Flexible premium, index, or flexible universal life. If it's got universal life or flexible in there, then it's the same thing. And very much like whole life, it covers you for your lifetime. And you can accumulate cash value that you can borrow from the policy. If you surrender it, you get your money, whatever's accumulated. Now you can choose a flexible premium payment pattern as long as you pay enough to keep your policy in force. Now this is the difference between universal life and whole life. Whole life, as I just said, that premium does not change. With universal life, you can up it, more go into the savings. You can lower it, less goes in. And as long as you cover the cost of insurance, you have that latitude. So if there are scheduled events in your life where you want to take advantage of that flexibility, or some things change during the course of life where you might need to lower your cost, or if you get blessed and you want to raise what you're paying, so more goes to the savings, all of those are there. And this is sometimes using that strategy of piling money into universal life policies is sometimes called infinite banking. Now, I'm not going to get into that, but it's basically using the benefits of a universal life policy to help you to accumulate money tax-free, and basically being able to use your own money to provide for things like financing cars and things like that, and then you pay yourself back, okay? All right, now, the last one is variable life. All right, now variable life is called oftentimes variable universal life, and that is that the coverage lasts for a long period of time. You can surrender it just like the whole life and universal life, but the savings portion goes into some type of investment like stocks and bonds, where you can get larger returns, but also there's more risk because the market doesn't always go up. It goes up and down. And if it goes up, great. If it goes down, not so good. But the fluctuations in the market affect your cash values and can affect how long the policy lasts. And as I said, people oftentimes use variable life as an investment vehicle more so than as an insurance policy, because it does have certain benefits, as in the money grows tax deferred, and that's one of the things that the insurance policies are able to provide for you. All right, so those are your four types. You have term, whole life, universal life, and variable life. Now the next thing is understanding that you have a sponsor here, the Private Money Syndicate. And again, we want to help you to understand all this stuff. And so reach out to us at privatemoneysyndicate.com or call us at 706-888-3719. So now we've been talking about all this stuff about policies. Now real quick, let's talk about insurance companies and agents. Now there are two types of life insurance companies. A stock company, Prudential would be an example, and they're owned by shareholders, okay? And they may be publicly traded. Now you may have heard of mutual companies, as in the name often, Mutual of Omaha. insurers own the policy, and they're often receive something called dividends. Now, policy dividends are not guaranteed, but what it is a return of part of the premium that the insurance company didn't need in the course of operations, and those are declared by the board of directors of the insurance company. Now, is there a difference to you as a policyholder between a stock company and a mutual company? Aside from the possibility of benefits, no, not really. So I'm basically going to tell you, only because there are two types, that you just need to know that, but it's not really going to impact you as an insured. One's not stronger than the other or better than the other, but again, you hear these terms, I just want to make sure you understand what they mean. All right, now, there are two main types of agents. There are captive agents. Now, captive sounds like hostage, but no, not really. But they're contracted to exclusively sell policies for a particular insurer or authorized by a particular agency. For example, Prudential only sells Prudential policies. Those are captive agents. Now, independent or non-captive agents can contract directly with a variety of insurers, and they are not restricted to who they can represent. Now, an example of that is Equus Financial. Now, they have a relationship with the company Ethos that I'm very familiar with, and Ethos sells online, which I'll talk about in a second, but those people who don't necessarily complete the process online, those folks get sent to Equus, and Equus can align them with any insurance company that's going to help that person meet their insurance needs. Maybe they have health conditions. Maybe they are looking for a large amount of coverage, and so they're in a position where they didn't find what they're looking through for an online platform, but they can work with a non-captive agent relationship to have somebody go out there and shop for them to find the coverage that they need. So you have your captive and your independent non-captive agents. Now, when it comes to buying life insurance policies online, we live in a technology age. There are all kinds of portals you can go to. But one of the advantages by going online is you can get quotes from multiple companies all at once. But now the policy premiums aren't going to change just because you went online. A lot of people think, well, it's cheaper because you don't have to pay an agent. No, the insurance company will just make more money. The cost or your premiums for the coverage will be the same. But now here's an interesting statistic I discovered. It says that a little over half, 53% of people shop for life insurance online, but only 14% actually purchase their policies. All right, because as we're discussing today, life insurance can be very complicated. And most people just don't feel comfortable, even if they find the cost or the coverage they're looking for, they have questions. Now, online underwriting models, in contrast to going through traditional methods of buying, can be more stringent. That is because they have to create a box, and the algorithm and all that stuff has to fit to make sure that, whatever the hump in the bell curve is, it aligns with the insurance companies being able to issue those policies. So those stringent underwriting criteria often lead to people being denied due to health issues or only being able to get certain amounts of coverage or certain face amounts of their policies because, again, it does not fit inside the algorithmic box that the online portals are able to provide. So again, nothing wrong with going online, but what happens is most people shop online, they don't buy online. So that's the online portal. Now, let's talk about how an agent can help you, because most people who do buy insurance buy it through an agent. And insurance agents can help you with your life insurance decisions. Now, independent agent can research and get quotes from multiple companies. So in contrast to going online to shop, an independent agent can do that for you. They can help you determine how much insurance you need. They can help you to get the coverage that you look for if you have health issues. Now, that is a really important one because oftentimes as you get older, health changes, as was the case for me, and by virtue of having somebody can look around and see who has the broader underwriting criteria for your particular condition at an age, that's where an agent can really be helpful to you. And you have someone to provide you personal client service when needed. For example, you move. Now, a lot of times when you move, one of the last things you might think about is changing the address for your life insurance policy. Or you change banks. Of all the things that you got coming out of your bank account, and maybe you forget about your life insurance, well, that agent would be notified and they'll call you. But one of the things, in my many years, I probably settled 40 some odd death claims, but actually having someone who can walk with you through that process when that unfortunate event occurs, but the insurance was there to help make sure that everybody and everything gets taken care of as quickly and as effectively as possible through the insurance company in their processes. So that's how an agent can help you. So We're coming to the end here, so let's recap and see what we've learned. All right, now we've talked about the different types of life insurance policies. Remember, you got your term, whole life, universal life, and variable life. Why people need to own life insurance to do the dime thing, pay off debts, replace income, pay off the mortgage, and provide for, mortality expense, take care of all those final expenses, and provide for education. We've talked about the factors like age and health that affect, and gender that affect how much insurance is going to cost. And then the types of companies. You have your stock companies, mutual companies. You have your captive independent agents, and then how agents can help you with your buying decisions and the services that you need at times along the way with your life insurance. So those are all important things. So going back to the subject, life insurance, why is it so complicated? Well, now you see why it's so complicated, but the important thing I want you to grasp is that you can get the help that you need, you can get the information that you need from the Life Insurance Buyer's Guide from the National Association of Insurance Commissioners, and you can find your good agent that you trust that can help you with these decisions and making these things happen. All right, so that's it for today's topic, life insurance, why is it so complicated? And I want to ask you, if you got any questions or ideas for some future episodes of the Mind Your Business Show, please email me, Tony, at privatemoneygodfather.com. Remember, I'm your private money godfather, and let us know what you want to talk about. The reason we've talked about life insurance today is because somebody wanted me to talk about life insurance today. Or you can visit the website privatemoneysyndicate.com. And today's episode is sponsored by the Private Money Syndicate, so you can reach us at privatemoneysyndicate.com or give us a call at 706-888-3719. I appreciate you being with us today, and as I always say, if you're going to go in business and stay in business, you got to mind your business. Thanks, and we'll see you on the next one.